Welcome back to another video in the series on quarterly theory. As promised, today I will be going over a model as it relates to that concept where you can apply this to your daily trading activities and see how it works for you. But it's a tested and proven strategy that works. I'd say this has a win rate of It has a very high win rate. I don't want to quote something that may not be true, but yeah, test it and see for yourself. All right, so go back in your charts and check. So I would have used for this video a very recent example of gold and how you could apply this model to gold trading, even the indices or any asset really. But because I tend to trade gold, then that's the asset that I would have used. All right, so this two-stage model consists of stage one. If you remember the video that we did at first, which speaks to sequential SMT, where you have SMT between adjacent quarters within a cycle. So in this case, we want to see SMT, sequential SMT between the previous day and the current day's high or low. And that should be in line with the higher time frame order flow and draw on liquidity. So we would be looking at this through the lens of the 1 hour time frame, which is the weekly cycle time frame. Stage two of the model would require us seeing also SSMT between the previous session and current session being traded in line with the weekly cycle SMT identified previously. So this would now be on the 90-minute cycle. And you would view this through the lens of the 5-minute time frame. So let me repeat. We're looking for a cracking correlation between the current day and the previous day, whether it's a high or low. But you would have looked at institutional order flow before to see where price is trending towards and what your drawn liquidity possibly is. And then you're looking to see a cracking correlation which aligns with that drawn liquidity and order flow. Unless it is that you're at a point where price is actually reversing and changing direction. Right, so if we're at old highs, such as a previous month's high and previous year's high, then you know those levels are strong and will create a reaction. And so it would be sensible if you get a sequential SMT. For example, price has been bullish and we have price reached to the monthly highs or the yearly highs. You would, if you get a cracking correlation at that point, then yes, that would be valid. But if we're inside the range and we get a cracking correlation, so price is bullish, we get a retracement, and we find that we get a bullish SSMT, then obviously the targets would have been the highs that were previously created. So ensure that you're in line with order flow and your draw on liquidity. That is important. So once we see that cracking correlation between the previous day's high and the current day's high, this could really have been the previous week's high and the current week's high, or could have been the previous session's high and the current session's high. But for the sake of day traders and for those of us who want to be in and out of a trade within minutes or hours, then this would be the model to use. So looking at once we see that cracking correlation at that high or low of the previous day, we then drop to the 5-minute time frame to look for our second stage SMT, which would be SSMT between the previous session and the current session. So because I trade New York session, I would want to see a cracking correlation between London and New York. And I would want that second leg of the SMT to fall within the third quarter of New York session. So New York is the third quarter of the day, so New York AM, and I would want to see that cracking correlation form within the third quarter of New York, which would be between 9 to 10:30 a.m. So ideally, that's what I'd want to see. If it is a cracking correlation for, say you had that SMT between the previous day and the current day, and that second cracking correlation was between Asia, London, then you would anticipate that New York would be a continuation of the London SMT, right? So you have to be logical about it. So what you'd basically be looking for in New York, if that is the case, is a retracement and a continuation higher, if it's a bullish SSMT. All right, so let's look at an example here. All right, so the daily cycle SSMT. So this is the 1 hour chart, gold. So what we see is this is the previous day, this is the current day. Similarly here, previous day, current day, and same, this would be silver, this would be either palladium, platinum, gold, euro, one of those other correlated assets, right? So we have gold trading below the previous day's low, silver failing, and the third asset also traded below its previous day's low. When we go to the 90-minute cycle of that same day, we will notice that this is London's low on all three assets. Silver failed again, while the other two assets took the low of London. If we go back a bit, the target for this trade would have been the previous day's high, because we're going from low of day to high of day, or low of previous day to high of previous day. Silver extended extensively through that target. The third asset would have gotten there, but in days after, and I believe gold got there, but not on the same day either. All right, so we see the cracking correlation. So we have two stages of SMT. We have the daily cycle and we have a 90-minute cycle SSMT. Now for entry, using what was presented to us on that day, the inversion fair value gap was the ideal entry in this case. So this was a news event. I believe this was CPI or unemployment, one of the two. And so we had a news event, pushed price higher. We had a retracement, and retracement brought us into this inversion fair value gap or inverse fair value gap. Entry here, target, first target would have been here, and the second target would have been that previous day's high. So it can be as simple as this. As I said, look into your charts, see what you find. As I said, it can also be based on the type of trader you are. If you're looking for the previous week's high, in terms of a monthly cycle SSMT, then you would be using the 15-minute time, the 4-hour time frame lens to look for that, and the 15-minute time frame as your entry time frame, and that second stage SSMT time frame as well. So I hope this was helpful. I will also give you a model which includes the precision swing point, and but this is quite easy to work with off the bat. So thanks for watching, and I'll be back again with another video in this series, which is quite informative and powerful. Okay, take care. Bye-bye.